Greetings, everybody. This is Jeff Scott, and welcome to this week's review. You notice the name has changed. That is quite intentional. I am going to be separating those parts of education from market updates, and I want to get this down to less than a half hour, ultimately getting it down to 20 minutes and smaller if I can. It's not going to happen overnight, but this is the first attempt at that smaller market update. For those that are listening for the first time and want more deep education, I refer you to the prior videos on YouTube. And as I said, there'll be more in-depth educational program opportunities as we go forward. It's January 9th, 2022, new year, new time, new story. HGSI@gmail.com is my email address, and I entitled today Growth Stock Smackdown. And I'm sure you know exactly why I use that title, because you're in the markets. This is for education purposes only. Any recommendation in the spirit of education, not investment advice. I am a doctor, not a broker. The tools I use are those I use in my daily trading. I have paid for the tools. Trading involves risk. You and you alone are solely responsible for any decisions you make. And I may mention the use of options. Option trading should be considered risky, and you should review material provided by the Options Industry Council before trading. As I have mentioned a couple of times, I will be participating in the upcoming Wealth 365 event. I will have this URL in the email that goes out to the few people that get my email. It'll also be on the YouTube site under the comments. It's a clicking talk when you get it. So right now it's 7 days away. So it starts on the 17th of January. As of right now, I may not be seen on the schedule, but from discussions I've had with Rob Hoffman, it looks like I'll be doing some stuff on Saturday that week and probably some stuff on Monday. I'm so excited. Why am I having this discussion with Rob, and why am I considering this? It's simple. It's about distribution and reach. I've been doing this for 20 years. I have a very small audience because I don't market. I don't use other people's lists. And with the work I put in, I should have a lot more subscribers. When you go to the website, a couple things, if you can do me a favor. If you like what I'm doing, click the up button. All right, I like that. If you don't like it, click the down button. Please consider adding comments where it says comments below. Under show more is where I typically will put the links to the other programs, including you can see the Wealth 365. This gear here is very important. When I click on it, it brings this bar up here. If this is too long for you, I've been pointed out by some users, they go to 1.5 and it reduces it by about 40%. The other thing is make sure you're watching it in the highest quality available to you. I do this in 4K. And again, I welcome remarks and comments, whether they're positive or negative, because I can learn from the negative ones, and it's always nice to hear positive things. So again, please come to this, or at least register for the event so you can find out more information and use this link if you will. On to the charts. So you're going to see the first thing that's different today is I'm not going to do the massive PowerPoint presentation. I think most of you will appreciate that. The other thing is I'm going to be spending more time on wealth charts than you've probably seen me do. I'm gearing up for my presentation there, but there's a lot of things I like in it, and you're going to see some of those as we go today. I'm watching the clock. We're at 3:45, so I'm going to try and be relatively fast. This is daily charts, spiders, Qs, and diamonds. And what do you see lower left, upper right in each of them? Yes, they've pulled back some, but we are much higher than where we were a year ago. We are in uptrends, although certainly the short-term uptrends are in some range. And if you look at the Qs, we're pulling into an area where you might expect to see a bounce with prior support. Is this a blown market that's bearish? Could be the start of a bear. I can't tell you. I don't have a crystal ball, but we certainly haven't broken down yet. The weakest of the markets is the Russell. These lines are here for a reason. We've been a Darvas box really since February of this year. You buy the bottom, you sell the top. We had a big tease here with a false breakout of a pattern you'd expect to come in to test the bottom, which we did. We're in the lower part of the pattern. If this was a full-fledged bear, where do you think the VIX would be? I don't think the VIX would be sitting here at 18 and change. So I think that's one signal that makes me think that perhaps we're not at the end. And then the dollar is important to me because I know that my portfolio does better when the dollar's weak. Well, of course, I'm heavy up on steel and iron ore and things that we've been talking about the last couple of weeks. Seems like every commodity is doing well that I follow except for gold and silver. And that's because of the inflationary economy we have. Well, the dollar falling is going to support that. Now, the dollar really is sitting at the 50-day line on support. It's bounced from here several times in the past. So that's something I have to be aware of. And if I drop out and I look at the weekly, I just want to point out that yes, whoops, I changed the wrong thing because I was highlighted in the wrong place. Let me try that again. If we look at the dollar on the weekly, you could see that we've come off the bottom, but we are well off the highs going back a couple of years. So I start with that, and I have to feel that this market is not done. It's at risk, but I think it might be a mistake to be too bearish here. Now, I will tell you, I was much more bearish before I started looking at charts, and I saw a lot of charts that looked attractive to me. Now, I also care about the market I'm in. And this slide here, and it's looking at hourly charts, tells me another story. On the left, I'm looking at a ratio chart, something that's very simple to do in wealth charts of large stocks, the IWB, versus small and medium stocks, the IWM. When I'm pointing up to the upper right-hand corner here, that tells me big is in vogue. When I'm pointing to the bottom, as I did back here, small stocks are in vogue. Well, large cap is in vogue right now. This is an hourly chart. If I look at it in daily, you could see a little bit different pattern, but also pointing up. It's just more dramatic when I look at the shorter term. And since we're trading tomorrow, not trading 6 months ago, I think the shorter term hourly makes sense. SPY G, growth, versus SPY V, value. If I'm a growth investor, I want it pointing here. It's pointing to the bottom. And this is a falling off a cliff. And this is what you're feeling with that growth stock smackdown. If you look at the hourly chart here, excuse me, the daily chart, oh, my bad, 1 second. I just keep forgetting to highlight. It's really a cool platform and easy to use. You can see the sell-off on the daily. I just have to remember to highlight the right story. Now, there are certain ratios that I've introduced you to over the last several years. I had to jump around programs. Again, ratio charts showing one compared to the other. Here's the spider, and obviously we see the spider is sold off some. Spider versus gold, strong markets, you expect spider to be outperforming, and you could see, even though gold is weak, spider, at least on the hourly charts, weakened versus gold. You also want to see the S&P doing outperforming bonds, and on the ratio chart here, you could see that over the last week or two, at least on the hourly chart, last few days rather, you've seen a weakening of the spiders versus bonds, okay? How about the Qs versus an equal weight Q? We know that the market is heavily weighted towards the big 4 or 5 NASDAQ 100 stocks. Well, it turns out that the strength has gone from NASDAQ 100 leaders to sort of a more equal distribution, meaning that it's not the Teslas, Microsoft, Amazons, Facebooks that are driving the market right now. It's sort of gone back to more balanced. And if you look at the spiders versus the RSPs, again, another equal weighted index, you could see that the big high cap leaders that have led the spiders up are not leading now. It's gone more to a equal weighted win. The top one and the bottom are some of my favorites where I get to look at things like the spiders versus FANG or the IBD 50 ETF. Up here, spiders versus the FANG ETF. What does this tell me? It tells me, at least on the short term, the spiders are outperforming the FANG. And look at how the spiders are outperforming the IBD 50. Growth is not in vogue. If I look at that in a daily chart, you could see that for a long time, and the duration of this on the daily chart, in fact, it looked like spiders were underperforming FANG, but of late, the narrative has switched. If you look at the IBD 50, however, on a daily chart, you could see that it's been neutral, and now all of a sudden, growth is failing as these spiders are surpassing the IBD 50. these are very useful to me and really save me a lot of time and money because I can avoid owning some of the programs I've had to pay for in the past. ARK versus the Qs, you could see that Kathy Wood's choice of beaten down growth stocks undervalued is way underperforming the Qs. I've introduced you over the years to the Guppy charts, the multiple moving averages, and looking at performance of the major indexes. For those that haven't seen these before, it's simple. In a good bull market run, you are going to run up above the major moving averages. And the first one there is a 50-day. And you could see for the most part of late, we've been running above and bouncing off that. Okay. Now we also see from time to time the markets will dive into the moving averages. So if I wanted to call category 1 a super strong market, that's the market that's above the goal. My category 2 market is when do I fall inside these moving averages? And I know that these are often shallow pullback corrections, not major market failures. Now, if I keep going back, you could see what happened in 2020. We broke inside, we broke below, all right? So if level 2 is being inside, level 3 is we've actually broken below the markets, and this is not a time you want to be long. And then my category 4 is when these moving averages flip-flop the order. Now, that's the end, and typically when that's happening, the market is starting to recover. So how do I manage this? I'm long as I can be when I'm running up over the yellow. When I'm in the moving averages, I take some profits and lower the number of positions. When I break below the yellow, I want to be short, and realizing that any long positions are going to be chewed up. And then when do I get back in? You can start to nibble when you break the yellow to the downside, but when you break above the band, that's to me is the all clear sign. So where am I at today? I'm level 1. I'm running up the yellow line on the spider daily. I am above the yellow line on the diamonds. That is strong. I'm category 2, level 2 on the Qs where I broke it into the moving averages, barely. And then I'm level 4 on the Russell, or level 3 rather, where, well, getting to level 4 as the averages are contracting and going to flip. This is unique because we're going sideways the whole year. So all these averages are going to tighten up. It's not a big distance to get above it. So big stocks strong, tech weakening, small stocks the weakest, and that's what it's been. Now we're looking, that's a daily chart. I can look at the sectors the same way. And again, on a daily, I see certain things, okay? On a daily, these are ratios, again, comparing to the performance of the spiders. No question, real estate, utilities have done really well on the daily. Even technology, if I open the window up, is still in the upper part, although it's selling off. I need to look shorter term, so let's look at ratio charts on the hourly. And if you look at the hourly, you can see rapid run up on financials, industrials, staples, real estate still strong, utility is strong, and look at how energy is going straight up. And materials. So inflationary and defensive things are leading. Now that I just learned a ton of information. I hope you did too from my run through some of these wealth charts, ratio charts. Very quickly, what else is driving this market? You know what's driving it. Go over to this one. This is, well, let's go start with the 10-year bonds or the interest rates. Spiked interest rates. Market does not like when it goes straight up. Bad for growth. So the 10-year and the 30 years have spiked. So, and again, I'm not even sure it's the absolute amount that's freaking out the market as much as the spike. Now, I want to look at stocks above the 20 and above the 40 very quickly. I got to change that. I see what's going on here. I need to be, okay. So stocks above the 200-day moving average. actually increased a little bit this week, or this is week. Let's put this on a weekly chart. That's on a deal. On the weekly chart, they moved up. You can see that. Stocks above the 40. There you go. On a weekly chart, moved up. So that's actually an improvement in breadth. And the T2121, which is the 13-week new high, new low, I've got so many things running, also moved a little higher this week. So what does that tell me? Here it is. Check that. It spiked early in the week on Monday, and it finished higher than it. Here's where it finished last week. Here's where it finished this week. So we can see that the stocks setting 12-week new high, new lows actually came down off their highs. So that's kind of interesting, and I think it shows the bifurcation of the market. But again, the point here is we're not sitting down here where the market's trashed and it's going to roll over. We're not sitting up here where the market has hit massive numbers where the market is going to pull back. I think we have a market that is showing signs of improvement and weakness at the same time. And it's just because it's a broad market, not one type of stock. If you look at the AD lines, if this is going to work, I really think I've messed up something on this today. Well, all right. Oh, back to weekly. Okay. The AD lines on the NYSE, what's bothersome, I got lower highs on the AD line in white. Turned down this week a tad. These are the major market ETFs. You can match them up with that. All of them turning down as well. And you could see down here that the TLT with higher rates also rocketing down. Let's kill that platform. EdgeRater gives me additional information. And again, if you notice, this is underneath the index stuff that's helping me understand what's going on with the market. Now, newsflash, we had two Hindys fire on the NASDAQ this week. 9.22% new lows on the NASDAQ. That's a pretty, no, I won't say big number, it's a giant number. A giant number, and getting to the point where typically it seems starts to recover. If you look, when I see two Hindys together, I get nervous. Classically, the Hindenburg-Omen fires on the NYSE. I like looking at the NASDAQ as well, so you have to take that with a grain of salt. Now look at the 9.22% new lows on the NASDAQ. Look what happens on the NYSE. No new lows at all. So there's no Hindy on the NYSE. So I would say there is no Hindy firing, but I'm a little bit concerned because of what we saw with the NASDAQ. Those who follow me for a length of time know about my buckets, which I learned from Ian. 61% of the stocks are above the midline of their Bollinger Bands on the S&P 1500. A little bit over 7% are above the upper band. Only 2% or so below. This is a bullish looking picture. How do I put this all together? The markets, I hear on TV how bad it is. It's a bear. It's a bifurcated market. It's not nearly as bad as you might think, at least yet. And then the other thing I want to look at is the warehouse view. So remember, if you've not watched me before, I take all the stocks in my universe, which are $2.50 and 250,000 and higher. I then look at ERG, which is EPS rank, relative strength rank, and group rank. Since I'm a growth stock guy, I want this line to be going lower left, upper right, where the more growth you have, the better you perform. And this is not a growth chart winning pattern. In fact, stocks with EPS ranks that were the best had the worst performance. Relative strength was also not a winning formula either this week. So tough week for growth, hence the title, Growth Stock Smackdown. All right, let's jump into HGSI very quickly. I love this program for some of the top-down stuff that I do. I've been using it for a long time. And we're going to start here with looking at the S&P 500. And very quickly, because we've already spent a lot of time, pull back to the 50. Is this broken? No. Look at the weekly strong uptrend since the March lows. Is it broken yet? No. Could it be breaking down? Sure it could be. And the sky could be falling too, for all I know. Just hasn't fallen yet. Dow Jones Industrials, it's above the 50 in blue, 17 rather, in green here. It's above the 50 in blue. Has this broken down? No, it's a shallow pullback into support. Is it done going up? I can't say that. I also can't say it's done. The market, as I said, it's a bifurcated market. You want to see some weakness? We can go down and look at the Russell 2000. 20 minutes here, still talking about the market. And you can see the Russell 2000 is broken down below its moving averages. Now, we also know from the prior picture that's in a box with the lower part of the box in this range. So the Russell is sort of in the middle between the top and the bottom of the Darvas box. Nothing has changed. If I want to look at things that look bad, I showed you a ratio chart with the IBD 50 ETF. Well, let's show you what it looks like in the real world with this a straight daily chart. This is the worst part of the market right now. It's broken down, or one of the worst parts. And FANG, unfortunately, doesn't look much better, also broken down. If I look at what may be the worst part, there's a lot of bad parts. How about NASDAQ Biotech? Why is NASDAQ Biotech doing so poorly? In my opinion, it's ran up because of Moderna and other stocks with crazy valuations in COVID. And as those stocks have come back to market, this has fallen. It has fallen a lot from its peaks, but it's kind of just getting back to where it was 6 months ago, not even 6 months ago, 4 months ago. I think there was a COVID-driven run-up, and maybe this is just normalization. Semiconductors, they're the ones I got my beady eyes on because they look like they're at sort of the line in the sand. They have not broken down yet. They're just a few pennies below their 50-day moving average, and they're still above their chandelier stop in green. I know that this has been keeping the market up, and as you saw in the wealth charts, when I looked at XLK, you could see that although we know that technology has been weak of late, right here you can see versus the spiders, it's just come off its strength. So let's hope that we see a bounce there soon, and I think we might. If I look at the dollar, I already showed you where the dollar was, so just showing you that it's also had a tough day. Mobile breakdown from a squeeze, a kahuna to the downside, some of my favorite indicators, and perhaps we're going to see a breakdown here. If I go down and I look at gold, you can see weakness here. So even with the dollar weakening, gold has not done anything. The same thing if I look at gold miners. And if you want to see a strength in the commodities, you can look at something as simple as oil. Oil looks different than the other charts. It's not quite to a double top, but it's moved up quite a bit. So again, am I rolling over in this market and turning bearish and just buying contra ETFs? You know, I might be by Tuesday or Wednesday, but I doubt it. I think this market still has some strength in it. If you watch the last couple of weeks, what did I highlight? I highlighted financials, big banks and little banks. I have Bank of America, Wells Fargo, and I got KRE on the small banks. I talked about metals besides gold, FCX, TECK, and energy, and those things have held up remarkably well. If I look at the industry groups, this also surprised me. I've got 34 to the upside versus on the short term versus only 7 to the downside. So again, maybe not as weak as we think. Make sure we're doing it by raw combo. So these are the top 10, and in the interest of time, I'm going to skip through these very quickly. Entertainment, content, I don't know anything about this industry, but they all got this pattern, a beaten down, horrible looking pattern, and they perk their nose up above their moving average. A Morales and Catcher Bible gap up, the weekly Bongo turned green, a mobile breakout. They've been in a John Person buy going back a couple of weeks, and a big kahuna. When I go through this, you start to see Viacom, similar pattern, Discovery, other Discovery. Something's going on content creation, and so a couple of those discoveries made it to my buy watch. Bank stocks, these are those small banks. Getting tough to buy these as they're breaking out, and finding those that are not broken out yet would be laggards. But we've been talking about these the last couple of weeks, and as I mentioned, I've been in KRE. So I've basically done the work already, and I've gone through the top 10 groups, and I ended up coming up from both my top down and my bottoms up. I came up with a buy list, and let me just show you how I can make that buy list even more powerful. So again, how do I get the buy list? By going through the top 10 industry groups and looking for the best performing stocks, and then looking at a bottoms up analysis, and then doing other manipulations of the list to come up with the stocks I like the most. So I'm going to put this up here for a second, give you some themes, and then I'm going to jump back into wealth charts and show you how I can make this list come alive. As you could see, many of these are going to be in those leading industry groups. I've got some banks, I've got some consumer finance, I've got that entertainment content, still have a lot of interest in energy. Many of these are extended, so I'm waiting for pullbacks. Midstreams are not extended for the most part. Insurance looked good. We're going to look at Cincinnati Financial, and then some of the steel producers and steel and raw materials like Vale. So there is strength in the market, but many of these are commodity based and economic sensitive. So what I'm able to do is I'm able to take my different watch lists and I put them into wealth charts, and I'm going to do my last 5 to 10 minutes in wealth charts. So as you can see here, this is sort of, I'm starting to prepare what I'm going to be presenting at the Wealth 365 event. And first thing I'm going to do is I'm going to go into the Wealth Finder and the Wealth, Wealth Scanner. And the Wealth Scanner is going to rank the stocks that I put into my list. So in my buy watch list, and I'm running it bullish, this is ranking with a strength score the stocks that I picked. Now, since I'm looking at technical charts and then ranking them, this is going to be a combination, as you can see here, technical, fundamental, and as more I learn, a number of different trading systems. And the one that came to the top is Continental Resources. Now, one thing that I've been playing around with and will continue to change is what is the right time frames to look at here. And because I'm not a day trader, but I don't want to trade something that was working well a month ago. So I'm looking at different time frames and settings, and I'll learn more about that. I include putting a lot of power on some of the annual membership indicators, the Wealth Strength Index, which I mentioned. Do I care about fundamentals? I may or may not care. I don't really care much about PE ratio. And so I'm applying that, and that's giving me my list. And you can see the list changed a little bit, and LNG moved up to the top. Now, I also have a bigger watch list that I do, and I love that I can bring these watch lists in here, and I can start to look for a more balanced approach. So as I look at this list, I see a lot of the same stocks that I've been talking about. Well, Alcoa, I mean, I got to give Rob Hoffman credit. He was doing a live event down here. And do I want to be in that one? It's a sneak peek. I'll comment on this in a second. Rob was doing a live event, and it must have been back here. No, it was over. Is it November? October, November. And during that meeting, he started talking about Alcoa. And he put up the chart, and Alcoa was just breaking out. And he showed his indicator set, and he showed this thing called throttling. And let me get Alcoa up here. And he was all over it. And this thing has just run up ever since he talked about it. But I think he talked about it actually further back here. But anyways, Alcoa, Diamondback Energy is one that I own already. You can see it broke out this week. Pay attention with the price charts right now. Devon Energy is one that I'm in. I talked about multiple times. Techninco, Freeport McMoRan, Bank of America. So I always like it when the same stocks that I own start making it to my buy watch list. So there's a lot of power here. So I wanted to pick one today and talk about it And let's see if I can find it, make sure it's on this list. And that one we're going to talk about is Cincinnati Financials. And of course, here it is. So it doesn't have a great wealth scanner number, which is bothersome. So maybe I shouldn't talk about it. All right, I'm going to talk about it, why I like it, and what's negative about it. And what I'm going to show you right now is top secret, and it's beta. So let's move over to the beta version of this. And you could see that I've worked with Rob and his team, and we're in process. And this is top secret, and I'm only sharing it with you, that we're building in some of the indicators that I use across the other platforms. The Bongo, which is something that I was involved in the development, 3 time frames on a single chart, my dots, and the high jump oscillator. And what I liked about Cincinnati Financial, and this is because it was breaking out above the 50-day moving average on big volume, coming out of a squeeze. It's not at an extreme of its high jump bar. And look at all the green dots. The pivot volume, the mobile breakouts, a PSAR reversal, and 3 kahunas in the last 4 days. Those who know me know that some of my biggest winners are breakouts above the 50 with that constellation of momentum indicators. What I don't like about it is it's kind of a loose pattern. Now, and it's sideways. If you look at the weekly just bounced off the 50-week. So this was one of the patterns I liked. And let me just go back into here to charts and scans. And one of the other ones that's higher on the list that I thought looked interesting. The challenge with a lot of these are they're already been bought and they've already run up. Well, let's talk about Continental Resources. Energy is a leading industry. As I showed you using the ratio charts of the sectors, energy is picking up. You know energy is doing well. Those who've been with me for a while know that my favorite pattern is to look at stocks in an uptrend, which pull back to support and then break out. So if you look at the Bongo, let's highlight the daily chart here. If we highlight the daily chart, let me give you some more action there. Is this stock in an uptrend? Absolutely. It's run from down here in the upper teens to close to 50. That's a giant uptrend. Has it pulled back? Absolutely. Here's the high. Here's a recent low. Notice that the high jump bar peaks at the high. So we're way off the high. It just broke out above the 50-day moving average. On the Bongos, the bottom Bongo is the daily, the middle Bongo is the weekly, the top Bongo is the monthly. That will be reversed. Like I said, this is a beta. As it says right here, chart beta. It's not available for anybody else but me. I am working on it, trying to improve and make sure everything works. Notice that I came out of the squeeze and I had a gap up, I had pivot volume, a mobile breakout, I already had a PSAR reversal, and I had a kahuna force, all of which, if you don't know, I'm going to talk about at my Wealth Charts event. This is a beautiful looking stock that broke out, gave up a little bit on Friday like many things did, but still trading near the top of its recent range. Notice the wealth signal came in here as well, and there'll be a number of other things that I can combine with that. Now, again, one of the big advantages about wealth charts is the fact that you can bring in many more indicators from different folks. And so let's go back to the CLR. And if you look at, I can use Tastyworks data, or I could use the data that comes inherent in the program. And there's actually a reason for both. So I've added some other things here. I've got my candlestick charts. I've got my chandelier stop. Still have to do some adjusting on that. These red arrows are something in the program as a what's called marketplace indicator for showing divergence. I've got my bongos. I've got my dots, which we'll get more talk about it. I have my high jump bar with the value, and then Dr. K tools. One of the things I love about this program is I can bring in other people's work. So it comes with a lot of standard indicators, the premium indicators. These would be things that people might be selling for other products that come built into the program for free. And then the marketplace is where you can get, and I'm not going to disclose what I'm going to be putting in the marketplace. Some things that are not in HGSI, frankly, are things that you can purchase from different educators and technology inventors. As a user, you can do however you want. Now, the other big thing that I love about this program is the real-time scanning. And so if I put in a larger buy watch list that I have, I call it the combo buy, which is mostly growth related, so it's not exactly the best strength right now. I can scan it at different time frames during the day, and that I can look for certain patterns that I like. And one of the patterns I like is new bullish. This is the ITP scanner, which is Rob's one of his great systems. TRP is a little simpler system. I actually like the TRP a lot, and maybe I'll talk about it in one of my programs that I do. I like them both, but what I really like is the fact that I can start to combine some of the things that I've historically done with the things, and this is just a white background, looking at the TRP, and let me get down here, and how I'm able to combine some of the things that I like with some of the things that Rob and other people use. On that note, I'm going to say goodbye. It's 37 minutes, which is an hour shorter than they've been. My goal is going to do a very quick top-down, look at a couple different things, try and limit the number of outside programs I do as I get more and more different. I don't know, the word's not comfort, but I've been using these programs for a long time. As I learn how to do some of these things in different programs, I will start to narrow the programs I use in these programs. And lastly, I would love to see you join the Wealth Charts events. I sit through as much of this as I can with my day job. If you're a subscriber, you actually can watch them afterwards. They show up on the Wealth Charts platform. Wealth 365 is a trading week. It's awesome. Lots of speakers, lots of different styles of trading. And it's also a great week to buy stuff because everybody gives some type of a discount or a deal, including Rob on his wonderful Wealth Charts platform. So don't tell anybody I showed you the beta, but remember what beta is. Beta is something that was just done. It's not ready for the market, and I'm using it and making sure it works because maybe it's something we can talk about next week. You all have a great week. Thank you, and give me feedback. Do you like the shorter format? Goodbye.